My name is Ken Scornia, President and CEO of Krilogy. I'm here with my partner, John MacArthur, Chief Investment Officer here at Krilogy, and this is your September market perspective. Welcome, Johnny. Good to be with you again.
Yes.
How was your month?
Terrific.
Was it terrific? Markets
fall season
kind of took a turn for us here, huh?
It's okay. It's been fairly orderly. Yeah, it has been.
Orderly and good process. I think it was, 6-8 weeks ago, we were up almost 18% on the S&P. Now it's peeled off, lost 8% or so. 10% up for the year, which, beginning of the year you would have taken that, but it sort of feels a little wonky at the moment. Market's a little jittery.
It is,
to say the least. What are you and your team seeing?
Volatility has set in for sure. The S&P, as we sit here today on a Wednesday, near month end, the S&P's up 10 or 11% year to date. Interestingly, if we strip out the top 7 large cap tech names, the other 493 names in the S&P are about break even year to date.
And that's been the story the whole year, right? I mean, even when it was up 18%, they were only up 3 to 4%. So.
It has been, yeah. It's been really, really narrow. We've seen a lot more new lows than new highs. The activity underneath the surface, of course, of the index level, given that statistic, has not been great. But if we step back from it, the last 3 quarters we're up 7 to 8% or more.
Right.
So to see some softness in a pre-election year, seasonality, doldrum type of period, which we at some level anticipated kind of this stagnant activity. Of course, no one has visibility around the depth of a drawdown, but an 8% or so correction is really healthy. I think the other thing is if we recognize and step back and look at some of the noise that's attributed to this sell-off, it's pretty meaningful. There's a lot going on. So we've got
government shutdown. We got UAW workers on
strikes,
strike,
which are extending.
That's right.
Government shutdown, as you mentioned, this Sunday.
Right. And for the binge watchers of Netflix, I mean, the writer's strike. I mean,
that's right. That's right. You get a little bit of anything and plus everything. Plus, you've got, you still have some geopolitical tensions. You still have a surge in interest rates. We've seen oil increase 35% since June.
The Fed
which you feel
still hawkish. The Fed is still firm on keeping interest rates higher.
Yeah, the Fed just took away 2 expected rate cuts next year from 3 to 1.
Right.
So if you factor all of those things in, this decline has really been pretty orderly, especially this time of the year, given the run that we've had. So
we talked a couple of months ago about the long range of the yield curve, and there's still been some volatility there. You expect to see some volatility there. What are you guys seeing?
Yeah, a lot of volatility in fixed income. I mean, frankly, it's this bear steepening that we've seen, where short rates are really staying fairly anchored. We've got the 2-year at 5.15 or thereabout, and you've got the 10-year hit north of 4.6% today.
Right.
Which is really, really quite a move. I think from a longer-term perspective, that just puts stress on valuations, and the Fed saying they're going to be around longer with higher rates really hurts those higher multiple, longer duration risk assets. But
if you're a bond investor, does that scream opportunity
for you? It does. If we look at things like equity risk premium, looking at expensiveness of equities to bonds, I mean, we're at 15 to 20 year levels of attractiveness with fixed income.
Right.
Equity risk premium, simply taking earnings expectations for the next 12 months over price. So let's call it 235 or 240 over 4,300 in the S&P. You're at 5.5. You take away the 10-year Treasury yield at 4.6. That's under 1, and it hasn't been there since pre-07.
But emotionally,
it's hard.
If you're a bondholder and you see volatility in your bond portfolio, particularly if the markets take a turn for you in the wrong direction, it's an easy button to say, you know what, put this in a money market. It's getting me 4.5%. I don't want to touch it. I don't have to worry about it.
Excellent.
But the missed opportunity on the upside, long term, is a real deal.
It's significant because you're either in that move from a positioning perspective or you're not. And I think when we look at where rates are now, and to your point, the opportunity in fixed income, longer duration fixed income,
right.
Not only do you have 4.5 plus in terms of yield, but you have appreciation potential, because inevitably the risk at the moment or the fear is not inflation, it's economic stability and outlook.
Right. That's right.
And we're seeing deterioration. It's mixed as to whether we see another Fed rate hike, but again, longer duration fixed income, when yields ultimately decline, which we think they will, particularly as we enter a recessionary period, which we can talk about here in a minute.
Right,
but
because the Fed's going to have, there's only so many, ways for the Fed to influence the economy, and that's one of them.
You bet. Energy prices isn't helping their effort.
Right.
So ultimately, that's the risk, right? Is that we get thrown over into a recession, and again, that tends to happen fast. Everybody is feeling kind of, the all clear as a function of price in markets.
Right.
Equity prices have been relatively stable up until this recent period, and so.
It's a unique silver lining in the bond market, not to stay too far on the bond market, that interest rates have gotten to almost a little bit more normalized levels, because the bond market can act as a hedge against the equity markets when the equity markets have problems, and act more quote unquote normal than they have been.
You're absolutely right. I mean, if we consider where rates had been versus where they are now, 550 basis points in Fed funds hikes, I mean, you truly have the benefit of negative correlation protection and equity market risk, because of course there's always tail risk type of events, credit risk,
right.
Credit events that lurk that no one can predict, and it's truly those moments where your longer duration fixed income will step in, because demand destruction will ultimately happen if recessionary periods develop and inflation goes down, and
Absolutely.
So
let's hop over to the equity markets. You mentioned a little bit about the S&P and how it's been, sort of led by 3 or 4 or 5 different, positions inside the index. What about mid cap, small cap, international? What are you seeing?
Yeah, they're trading historically very cheap. That certainly doesn't mean they can't continue to do that. I mean, if we look across sectors, again, many are negative on a year-to-date basis. It's worsened since our last update, that we had a month ago. But again, looking forward in economic weakness, when investors, consider free cash flow generation, valuation support, it's areas outside of technology that have felt the brunt of this pain so far. A lot of this year, where it becomes a relative performance game. I would argue that you'd see better downside protection in a lot of those areas that have been hurt. I think further, we think going into Q4, we think there's, another run up the hill, so to speak, in terms of markets.
Yeah.
Q4 has tended to be a strong period for markets, certainly in pre-election years. Obviously, it could get worse before it gets better. But we've seen, in terms of catalysts going forward, there's a number of things out there. We're entering a stock buyback period here in mid-October. In the CNN Fear and Greed Index, we just hit extreme fear.
Yep.
So we've worked out some of those.
Always a classic
classic contrarian indicator.
Right.
Any type of peak and rollover in any magnitude of the dollar and yields, which we think we'll see. We think we're close to that. That would be a catalyst for risk assets. I think active money managers are generally underweight equities relative to where they should be. If we look at where they began the year, generally underweight tech. There was a catch-up trade that happened. I think there's some right sizing and positioning that's likely to happen in terms of trying to make their year, if you will, from an equity risk perspective.
And there's that third piece of the portfolio that we speak often on these videos, which is the alternative side, the alternative investment piece. Speak to us about what you all see out there.
That's been just to continue to be really just a predictable, stable place for our clients. Whether we're talking about daily liquid alternative solutions or something less liquid, private market exposure, really meant to invest for 3 to 5 years plus down the line. I mean, those segments have held up really well. They're often, less correlated, but they're also cash flow oriented, which again, in a year where the aggregate bond market index is still negative, it's helped a lot. So you get diversity of exposure, often you get cash flow generation, different sources of return from equity to bonds. It's helped.
You've got a good sense of what's happening with our advisors, with our wealth advisors, really all over the country at this point. What are they seeing? What kind of questions are they coming to you with? Via their portfolio management style and/or the end user, the client, which is the most important piece. What are you seeing?
You've touched on a big one, which is the temptation to just grab what's in front of you from a yield curve perspective. The 5 to 5.5% in treasuries and/or CDs, which again does make sense, but not too much. I think the equity market volatility and the tight money policy era that we are in, is I think that's being felt more, and investors are recognizing that expected returns are likely to be less going forward,
right.
and so they're reassessing. I think for most people, the last 10 or 15 years, it's been the tech trade. It's been growth. And
it's been a true easy button.
It has in that regard.
For most portfolio managers.
Yeah, it's why we think that really assessing your equity exposures and getting more balance continues to make sense domestically and globally.
I got to imagine your trading team's been really busy with the volatility over the last 4 weeks, with markets bouncing all over the place. It creates opportunities for you all on the portfolio rebalancing.
Our dynamic rebalancing process has been active with the volatility increasing. Charles Flecky and Paul Ray do a great job for us in that regard. It's truly in good conscience being able to be active at all times when the time is right to do so.
And rebalancing in the most perfect spot, really.
Yep.
Inside the market volatility is what
when
we want.
Assets get mispriced.
That's exactly right. So, anything else? Any final thoughts, John?
I don't think so. I think I think 30,000-foot view. Again, we've been in this push-pull. Fiscal policy has really continued to propel markets for a lot of the year. We've got infrastructure spending, Inflation Reduction Act, CHIPS Act, have all been kind of this push-pull with what the Fed's trying to accomplish. In quantitative tightening, shrinking the balance sheet, tighter policy, and I think normalization of that going forward will happen. I think valuation is more important than ever. We can go through long stretches where it doesn't matter. We think it matters going forward, and so investors being knowledgeable about what they own and what positioning looks like in those three core buckets for us, equity, fixed income, and alternatives, is really important.
We live in interesting times, and there's always fun conversation going on between us, our investment committee, and our leadership here at the firm, and our wealth advisors. And I think to myself, it's just so nice to have an investment process that is built off of fundamentals, that no matter what's happening, no matter what the noise is, no matter what the news is at the moment, the fundamental process of the way you guys manage money really should give both our advisors and our end clients really a sense of security, that the process is in place.
The process is really important.
We're not going to be emotional.
Right.
We're not going to follow the latest headline, no matter what that headline is. It's more about the process. So.
And we were just talking before this, if I may, and one final closing thought, our work in increasing duration on the fixed income side. I mean, the ability to call top on anything is impossible in terms of yields, and so we've lengthened duration as the 10-year has continued to climb, and here we are at 4.6, 4.65 today. We're not at our next point yet, but if we continue to see this incredible surge in yields on the 10-year, again, we've got process in place that we're going to go for another turn to average in, because we care about portfolio performance out 6, 12, 18, 24 months. So the next week or two or month, it doesn't matter. So being mindful of that's important.
Yeah. Process is the most important thing.
You bet.
Well, thanks, Johnny. I appreciate it.
Thank you.
And thank you all for taking the time to listen to John and I just have a quick conversation about the portfolios, the economy. And we thank you for the opportunity to be stewards of your wealth. So for Kent Scornia, John MacArthur, you have a wonderful day. Thanks.